Right, we move on to another chat now with Paul Fisher and his wisdom from the Bank of England and me, many years of teaching the theory of these topics. And we're moving just gently away from monetary policy, not totally away from monetary policy, but gently away from monetary policy. And we're going to talk a little bit about fiscal policy. Do you want to kick off on this one?
Yeah, fiscal policy is a difficult topic. We used to think, going back in the day, that fiscal policy was all about setting the difference between government expenditure and taxation, and using that to try to boost the economy or not. I guess the one thing that I came to realise after many years of following fiscal policy is that this is a lot less simple than it sounds. Government expenditure is nearly always on socially necessary things like health, education, defence and justice, if that's the way you lean. And it's very difficult to adjust any of those things up and down with the cycle. And similarly, tax policies can have important impacts on the supply side of the economy, disincentive effects, incentive effects. And probably the best thing you can do with a tax policy is to have a neutral one, so that it doesn't distort the economy any more than you need to. And once you've got these things set at about the right level, which I guess is where we may have some differences, yeah. I don't think you should be fiddling around with either of these things, because they're just too important, one for the economy, the supply side of the economy, and one for social justice. And so the best fiscal policy, I think I would advise, is to allow automatic stabilisers to work, which is basically set your targets for how much spending you want in a normal state of full employment, and taxes similarly. And then as the economy cycles up and down, you'll find that your deficit goes up when you have a recession or a slowdown in growth, and it'll go the other way when you have a slight boom. And you allow that to work because it helps offset the fluctuations in the economy. But if you try to use fiscal policy to deliberately stimulate or contract the economy, you can make things much worse rather than better. It takes a long time to recognise what you have to do, it takes a long time to do it, and it takes a long time for that impact to have an economy. On the other hand, if you get the balance between spending and taxation wrong, as we have done in the past, that can also have severe consequences. So it's a very important question, but I don't think it's one for demand management. I think it's more one for trying to work out what the best fiscal policy is to support sustainable growth.
Right, thank you, yes. I'll take us back a little bit before dealing with some of the things that Paul has said, and that's take us back so that people understand exactly what fiscal policy is. And I'll start by suggesting that pre-John Maynard Keynes, so pre-World War II, there was no fiscal policy. There were budgets, so every year the government was running a budget, and that budget tended to expand and contract with the economy, in as much as if the economy was expanding, the government received more revenues, they spent more, and they were moving, if you like, with the cycle. When the economy was slowing down or even contracting, then the government received less revenues, so it spent less, and it again was reinforcing that cycle. And what John Maynard Keynes said was that governments should be acting in a counter-cyclical way in order to stabilise the economy. That is, when the economy was expanding, then the government should be holding back, and when the economy was contracting, the government should be boosting the economy. So, in other words, acting in the opposite direction. So this then becomes using the government budget to manage the overall level of economic activity in the economy. So when the economy is contracting and government revenues are falling, they should budget for a deficit so they expand the economy or stop that contraction taking place. And during those periods of time when the economy is rushing ahead, then government should budget for a surplus. They should take out some of that demand. I think Keynes or people at the time often described this as being a thermostat to a heating system, that when it was overheating, the thermostat would turn things off. When it was underperforming, the thermostat should be turned back on. So fiscal policy became this counter-cyclical policy to manage the economy. Now, I would often suggest it didn't work because of a political element in this. What happens is that if you want to persuade politicians that they must spend more money, then they quite like that idea. So they quite like the idea of budget deficits. But if you've got to tell them, no, we want you to budget for a surplus, we want you to cut spending, we want you to raise taxes, then they were never quite as keen to do that. And I worry that another group of economists who like to call themselves Keynesians came along and solved that problem by suggesting that their governments can always run deficits. They run bigger deficits when they want to expand the economy and smaller deficits when they want to slow that expansion, which takes us away, if you like, from the idea that Keynes originally put forward, which was surplus budgeting to bring back the economy to some stable growth line. So from my point of view, fiscal policy is managing the overall level of economic demand in the economy, using monetary, using fiscal policy, using policies which expand and contract. And because they act in a counter-cyclical way, then you would expect, I suppose, if you're looking over a period of, shall we say, 50 years, that you'd have roughly 25 of those years when there were budget surpluses and 25 years when there were budget deficits, ironing themselves out over a long period of time. But of course, if you look back over the last 50 years, I don't know what is correct here. I'll leave that to the realists. But I suspect we're looking at 4 or 5 surpluses and 45 deficits, which is, I don't think, what Keynes actually said or what Keynes meant. So I'm very critical of fiscal policy. That is, it has not been used properly, and for that reason well, let's wait until we come to the end. I'll set out what I think fiscal policy should be, because there are other things to deal with before that. And one of these additional points that we need to look at is the fact that I often teach, and Paul himself, when he's got his teaching hat on, will teach fiscal policy as something which is separate from monetary policy. And we'll have monetary policy where we're dealing with quantity of money and the price of money. We'll have fiscal policy where we're dealing with taxation, borrowing and spending. But of course, they're not as separate as the textbooks might want to suggest. And can I throw that one at you, Paul? Can you talk about the connection that you think there is between fiscal policy and monetary policy?
Yes, and there's several different ways in which it works. First of all, anything which has an impact on the economy has an impact on monetary conditions, which the Monetary Policy Committee might have to react to. It doesn't matter whether it's fiscal policy or what football clubs do, anything could have such an impact. But specifically, the way fiscal policy works these days, at least. Well, actually, let's go back to that. When you have a fiscal deficit, you have to fund it somehow. And technically, you either print money or you borrow money to fund a deficit. If you print money, well, that's usurping the central bank's role, really, in deciding on what the appropriate level of money base is. And I think over time, that always generates inflation. And many countries around the world which currently have inflation, and there are a lot, it's nearly always because the government has spent too much money and has printed it, one way or the other. The alternative is you borrow, and in the UK we've had a formal policy that you borrow in order to cover the government deficit. For that's been the policy for a long time. But when you borrow, you issue debt instruments to the market, and you have to set an interest rate. The market will set an interest rate on those debt instruments, and that will affect what we call the yield curve, the expected path of interest rates over the future, and that itself will have an impact on monetary policy. And actually, what we found in the last 10 years is the causalities worked a bit round the other way, because the Bank of England has been going to the market buying lots of UK government debt, and that has impacted on the yield curve. And so actually what we've found is that monetary policy has been impacting on fiscal policy. And so you've got this sort of quite linkage. And when I was at in the markets area at the bank, we had to be very careful with our QE operations that we didn't do them over the top of operations coming out of the debt management office, which would have mucked up the gilt market. And so there was a timing issue all the time of when we did our operations to make sure that everything was sequenced. And we were quite transparent about that. It wasn't a secret. But yes, there's all sorts of ways in which the government funding itself is connected with monetary policy.
Good, thank you. And it is important that for anyone studying fiscal policy and monetary policy that you do also see the links between the two, because you cannot pursue one policy independently of the other. Paul is much too young to really know firsthand what happened in the 70s in the UK, but it was very much at the time fiscal policy that drove things through the 70s, and monetary policy was the accommodating policy. So I do tend to blame the 70s upon the Treasury and the government, in as much as they had very lax fiscal policies. But I give some responsibility there to the central bank as well, in as much as it was accommodating this. And to my mind, it is exactly the problem that you have with Keynesian economics. If you try and expand, you get inflation, and you try and accommodate that inflation with higher monetary growth, and you get higher inflation, you get higher inflation. So Paul wants to say something, but I better finish this. No, all right, go on, you say something.
Yeah, I just think it's really not that easy. What happens if the fiscal side get it wrong?
Yeah.
And around the world, if you look, it's going to tend to be you have too big a fiscal deficit. The government spend too much and they tax too little. So
Yeah.
Now, as a monetary policy committee, you can offset that in terms of inflation by having higher interest rates. So in terms of internal balance of the economy, the monetary side can offset the impact from the fiscal side. The problem is that higher interest rates relative to your neighbouring countries will push up on your exchange rate. As people say, oh, look, there's not much inflation, we can get a higher rate of return, let's take our money and place it short term in the UK where they've got higher interest rates, and that will tend to push up in the short term on interest rates. That encouragement of cross-border capital flows can go into your financial system and create financial bubbles. Why am I saying this? Because it was exactly what happened in the early 2000s. We didn't know, I don't think they appreciated it at the time, but fiscal policy was too loose. We had the highest interest rates in the G7 for most of that period. Our exchange rate was clearly too high. Our current account deficit was going down, getting worse, and we had big capital inflows coming into our banking system, which is why when the great financial crisis hit, it hit the UK more than it did many other countries. And so we do get this. If you're a monetary policy committee, it's not enough to just target inflation and hope the economy as a whole will then be stable. If fiscal policy is in the wrong place, eventually the economy will come unstuck.
Oh, certainly, they do both need to be moved together. And Paul has almost taken me to my next point. I was obviously moaning about the 70s and both fiscal and monetary policy being too loose, and perhaps a bank that was tending to follow too much the mistakes that I observed in terms of fiscal policy. And I was going to take him up to the period that he's just spoken about, and that was the global financial crisis, which led initially to a decision at the G20, wasn't it, back in 2009 in London, where all governments were going to use fiscal policy to take us out of our problems, and there was a big move towards large fiscal deficits. And then there was almost a feeling, oh dear, no, this hasn't worked, has it? Over to you, Bank of England. What can you do? It does seem that fiscal policy is not working here, and I did feel very much as though the Bank of England was then tasked with trying to take us through an expansion because fiscal policy wasn't working. I don't know if that's how you saw it at the time.
Nearly, but not quite. I mean, actually what happened, of course, was within a year or two, governments were frantically trying to reduce their deficits because the economy told them so far the deficits have ballooned up. And actually, the combination we got from about 2010 onwards was tight fiscal policy and loose monetary policy, and that was thought to be the best combination that would restore growth in the economy. But one way or another, and it didn't. And I think that's because the missing element of fiscal policy, which is the supply side impact. We try to set these conditions so that the private sector can grow the economy. But if you don't create the conditions for that properly, then you won't get very, very strong growth. And actually, neither monetary policy nor fiscal policy, as we have defined it so far, will generate growth in the long run. That has to come from more productive investment and operations in the economy as a whole.
And you have said exactly what I always think and try and teach. That is, it is the private sector of the economy that is the driver for growth and economic growth, and it is the public sector macroeconomic policy, if you like, that creates that environment within which this will work properly. The stable environment, whether it's prices, whether it's interest rates, whether it's government spending, government borrowing, stability created by these actions is what the private sector needs to move forward, be able to estimate future revenues, to be able to identify the extent to which it should borrow and how much it can invest using borrowed money rather than, shall we say, retained profit or whatever that may be. So that comes to quite an interesting point, because I think the national debt was around £550 billion at the start of the crisis back in sort of 2008, 2009. It has now ballooned to 2.58 trillion, depending upon which set of statistics you need, which is a really big movement to an ever larger national debt. We blame the global financial crisis, we blame the pandemic, and perhaps we blame policies that have driven governments to move from bigger deficits to smaller deficits, back to bigger to even bigger deficits. I don't think Keynes, if you look back to the original policies Keynes was pursuing of looking for budget deficits when they were necessary, budget surpluses when they necessary, would actually look at 2.6 trillion of national debt and think that that's the right thing to do, to be national debt nearly 90% of GDP does seem to be an economy out of balance, and we have a problem with such a large national debt. Some economists will say, no, we don't. I say, yes, we do. What do you say, Paul? Do you see this as a problem, a national debt of that size?
It doesn't have to be a problem, but it might be. Well, I'm going to hedge my bets on this one. So the thing about debt is that it has to be sustainable. So most of us in our ordinary lives have quite a big debt burden at some point or another, because we take out a mortgage to buy a house, and that's really the only way you can do it, and you service the mortgage, and that's paying for your housing services. Debt in itself is not an evil thing or something to be avoided, and countries can have debts. And government debt markets are an important part of financial markets. They give a risk-free rate of return against which people can compare things. A lot of pension funds and other investors need risk-free assets, and government debt is the thing they buy. And some countries where the national debt has been run right down has caused quite serious problems, like Australia. Now, they've got over that in the last 5 years and managed to issue some more, but they've had to bring in artificial measures in order to offset the fact there wasn't national debt. But the key thing is it has to be sustainable. Now, there's two aspects to it being sustainable. In the old days, we used to think about this just in terms of the level of the national debt and its trajectory. You don't want national debt to be ever increasing as a share of GDP for a given interest rate, because that will mean that at some point you won't be able to fund it. And that's eventually what causes problems. Nobody knows exactly where the limit is, but there was a strong argument that we ought to keep national debt below about 60% of GDP in order to make sure it was safe. And actually that gives you some room for expansion in a crisis. But more importantly, it's not just the level of debt, it's the actual interest cost of it, which has to be sustainable. Now, actually, at the moment, interest rates are so low And real interest rates, about 40 to 50% of UK debt is index linked and has a real negative interest rate on it. And so people are actually paying the government effectively to lend the money. Interest rate costs have been measured by the Office for Budget Responsibility and published and shown that at the moment costs of the national debt are very low. They're actually much lower than they were before the pandemic, despite all the extra debt that's been issued. So it's not a problem at the moment. Now, when interest rates eventually go up, existing debt in the market won't change its interest rate. It will be new debt that's issued, which will have a higher interest rate. If we're still borrowing excessively at that point, that could be something of a risk at that point. And so there will be a bit of a race, I think, to get the deficit down before interest rates need to be a lot higher. So it's not a problem at the moment. Actually, it could be quite good. There's no shortage of people willing to buy UK government debt, that's for sure. But you couldn't carry on borrowing at these rates at higher interest rates, or you'd really be in a pickle.
I agree with you there, but I also worry as well, are we cheating a little bit here? Are we creating a situation with very low interest rates where governments can overspend significantly and set a rate where its repayments are very low? And could it then get carried away with that situation and continue to do it? And is there a sort of brick wall ahead where suddenly you're going to realise that this is not sustainable? And I think both Paul and I agree that there are sustainable words that need to be used here, and unsustainable as well is a worry. Now, both of us do teach undergraduates and people younger than ourselves, and one of the things that they seem to worry about is the idea that the national debt is creating a burden for them. It's creating a burden for future generations. And I am afraid I cannot put their mind at rest. I have to say, yes, it is. I have to say, you are creating a burden for the next generation in terms of a national debt, which at the moment, little under 90% of GDP. It isn't something that goes away. There was a time when we argued that no, we weren't creating a burden for the next generation, because if we borrow money now and spend it wisely on infrastructure and strong investments, then the rate of growth will be higher into the future, and although it will cost you a little more, you'll be sharing a much bigger cake as the economy grows. But of course that argument doesn't work if the economy doesn't grow. If the economy doesn't grow, there are still burdens which are carried forward into the future. There are economists who disagree with this entirely and say, no, there are no burdens into the future, and there are our modern monetary theorists who argue about no burden into the future. But one of the things that does worry me about very large national debts is this carry forward, and that there is some commitment by the people coming after us to deal with our debts. I always suggest that my standard of living now is much higher as a result of the money that is being borrowed in my lifetime, and I therefore thank my students for the fact that they're going to help that to be financed into the future. Not an idea that is supported by all economists, but how do you feel, Paul? Do you think that there's a burden for the future generations of very large national debts?
I think that there are two risks I would see. The first is that, as we've seen with the pandemic, you can have events, national events, which shock the economy and which mean that for a period of time you need to be able to borrow. If our deficit and national debt had been so high at the start of the pandemic that we could not have borrowed a lot more money, then we would not have been able to take the supportive measures for the economy we could. And the same might apply, by the way, in a different context, if you were suddenly to enter a war and you needed the money to pay to produce munitions or something, you wouldn't have that if your positioned if your deficit and debt were too high. So there's something for saying that in good times you ought to be getting your national debt down, so that you know there's going to be bad times and you might allow it to grow again. And again, it's allowing, some of this is allowing the natural stabilisers to work on the national debt, not just on the deficit. So I worry about that. For me, the bigger burden I still worry about is funding pensions, because people have been getting older. Actually, it's settled down a bit in the last few years. but we don't have a pay-as-you-go pension system. We expect our future generations to pay ever-increasing pensions out of future income. And so we are creating burdens, even though it's not recorded in the national debt. It's a national liability we are building up for the future. And if the economy doesn't grow, a lot of people are going to get negatively surprised by their pension outcome if they're relying on the state, at least, to do that. And we have actually seen that come to fruition recently when pension ages have been pushed up, particularly for women. And a lot of people have landed themselves or been landed in positions where they don't have the pension income they were expecting.
One thing I would like to see into the future, and I'm sure Paul will disagree with me here, so we'll probably make this the final point of this little chat, is that I would like to really force legally governments now to balance their budget, and to balance their budget every year until the proportion of the national debt to GDP falls down below, I would go down to 35%, where I feel things could be comfortably managed. So almost immediately, within 1 or 2 years, I would like government spending and taxation to be brought together, the government balancing their budget. Almost there's no fiscal policy anymore. We just want sustainable government, a balanced budget until all of the public finances move back into some sort of order where I think everything could be sustainable. What do you think about that, Paul? Do you fancy balancing a budget from here on in?
I think I wouldn't do it right now because I think the economy is still too fragile. And I think what we have seen over the last year or so is exactly why we don't have that sort of legislation, which is things come along which you hadn't expected and you have to break the rule. These rules, you can't actually legislate against what a future government might want to do. It doesn't mean you can try to write in rules, but any future government can always overrule them, so they can't be binding. We used to have by law the fuel escalator and the cigarette duty escalator, and when governments didn't want them anymore, we just suspended them. If you remember, as a result of the coalition, we brought in fixed 5-year term parliaments. Well, that was abandoned at the last election. As soon as everybody agrees we want to have an election, we have an election. So you can't commit future governments under UK constitutional arrangements anyway. I think I would like to see the general principle, which is that if the economy is at reasonably full employment and growth is okay, that you're trying to reduce the national debt. You can reduce the national debt without having a balanced budget, of course, depending on what's happening to interest rates. But I think you tighten the purse strings a bit when the economy is going well, in order to be prepared for the next time it's not going well.
And there you have it. You have the theory of a world that I would like to see, and then the practice of Paul as he sees things have gone in the past and how they should go into the future. I hope you've enjoyed that little chat between us, and we'll be back for another chat again after this one. Thank you.